All right, welcome back to the channel. This is my morning routine prior to day trading. All right, so rule number one, before I even trade, when I'm looking at the markets in the morning before market open at 9:30, I always have this up and just looking at the indices and looking at the SPY, the Dow Jones, and QQQ, and I want to get an idea, is the market, is it positive or is it in the red to start off the day? Because that can sometimes give you an inclination of what the market is going to be doing. And obviously this isn't like a foolproof thing. The market can do whatever the market wants. But if you're going to decide to go long that day, it's good to just know what's the overall strength of the market, what's actually happening in the news, is there anything going on that could impact it, and always just consider those options. So if you see the market is really red, it might be a good idea just to check the news and see if there's general bad news out there that's causing it, or is there no bad news and the market's just selling off for no reason. So it's always good whenever I start my trading in the morning, I always want to see what the general news is and check out what the SPY is doing, which the SPY is your S&P 500, DJIA is your NASDAQ, I'm sorry, your Dow Jones Industrial Average, and QQQ is your NASDAQ. And you can take a look at what they're doing. So I always look at all three of these. I have 5 of them up, but I like these specific 3 to just see if the overall market is green or red that day. And that's how I start off at first. All right, so rule number 2, I like to look back 5 to 10 days. So right now I have the 5-day on. And this is just TQQ. This is the triple leverage NASDAQ that I trade often. So I'm just using this as an example. I like to draw a quick support and resistance, and it doesn't have to be perfect, but I just like to have an idea. So when I'm trading the stock during open hours, I already have this drawn out. And this is 5 days, and I see where did it get support from. And I just quickly, Fidelity doesn't do the best with the support and resistance lines, but I just draw lines like this, where now I can see that right here was an area of support before it ran up from 56 up to 62. It popped right again here. It went from 56 back to 57. So if I'm planning to buy the dip, or I think there's a potential resistance, I look where did it have resistance and support levels. And I see that currently it was trading at 57.93, and I see that right here, it had a little bit of resistance here. So if I'm trading or I'm in the stock already, I just want to have these marked up. So when I go back to my day chart and I'm just looking at it and I couldn't see this in advance, and let's say it was before 9:30, so I'm just going to make it so it's only like we're looking at the market at 9, let's say we're at the market, it's 10 o'clock. I zoomed in on it. You can see the time, 7 a.m., 8 a.m., 9 a.m., and just pretend that it is, 10 o'clock, the market's open. And I made my support lines and my resistance lines already. So I can see them right here. I already made it. So right now I know this would be a potential resistance line somewhere in this ballpark area. And as the day goes on, if the market continues to, right now like it's going up, but if the market were to sell off, we're going to be able to see my support line come into effect. See, and if I zoom out a little bit, you can see it better, but it gives me an idea of where support would be. Now, obviously, it wasn't exactly working entirely. I used different other things like the EMAs, which is, I have other previous videos that explain that. But if the market continues to sell off, I like to at least have levels to know where it could potentially bounce off of. And when I zoom out completely out of this, just go to the 5-day, it can just give you a good idea of where it's trading in, like what zones. So it's just a quick thing, and it doesn't have to be perfect, but it's just good to have an idea, because if the overall market is trending downwards and you're going long, you might just want to at least know where the most recent support level was, because if it breaks that, you could expect it to go even lower. So I just think that's always a good thing to kind of just keep in mind, is draw your support and your resistance levels. So when the market starts trading and you're going through your stocks, as long as you marked it, at least in the Fidelity Active Trader Pro, they'll just stay on for the day. So you'll have them. And then as you're trading, oh, you'll see this and you'll be like, oh, okay, well, I know the support is somewhere in this area. It gives you more confidence to buy instead of just buying because you see a low RSI. You want to think about like what's the news that day, what's the overall market conditions, Is the, if you use RSI, is it, I have other videos explaining this, is it a low RSI here, or is it at a high where it's overbought? So it's just different things that you could use to start to have more confidence in your trades, especially if you're going to try to swing trade them or just scalp for the day. All right, so rule number 3, when I'm buying the dip, this is just for myself, but I would just like to share it. I never buy the third retest of a support level. So let's say this is the market right here. It's 11 o'clock because you can see the time here. And I know that it's tested once, twice, 3 times. If the stock starts coming down again, I refuse to buy it even if the RSI is low. And what's my reasoning? This isn't like a fail-proof thing. It doesn't mean it always works. But I just don't feel as confident if the market continues going on into the afternoon, 10:30, 11, and it still hasn't gone up. I don't like to buy on the third retest. So 1, 2, 3. This is even the fourth. Now, if we just pull it out there, start looking at the day, look at that. Once it broke this support level, you could see that it just sold through. And obviously, we're looking at this knowing what it's going to be. But this is why I just, in my past experience of just buying support levels, anytime that it retested like 2 to 3 times, and now the 4th time, it seems like the sellers are just, the bears are taking over and they're going to eventually win. So if you were to buy at this support level thinking that, oh, hey, this RSI is low, if you bought right here, I've done this plenty of times in trading, and then I have to get stopped out or I just take a bigger loss than I wanted to, because the RSI looked good at 28 over here. But the problem is it just kept testing it, and then it sells off. So one of my rules is I don't buy support levels if it's retesting it a few times. And this is from rule number 2. I have the bottom support level that you could see on the 5-day. So I'll just go back to the 5-day real quick because now I just drew 2 support levels, so it makes it a little more confusing. But like I drew this in rule number 2, and you can refer back to that. And look where it got the pop. So I was doing the previous support, it tested it 3 times, it broke this level, went down to here, and then that became a support for it. So that's why I like to do the pre-market, look 5 to 10 days before and see where it's been getting support. So this, look at the support level. This is, if you just went 5 days, this became a support and then it retested the new level that it broke. So I always just don't buy dips on the third retest because time after time, I've been trying to do that, and I've learned that you just get burned most of the time because the support is not there because it seems like the market wants to make a new low. So let the market tell you where it wants to go. If it wants to go down, then don't take a long position because that day it wants to go down. You're better off shorting or just trying to go with the trend. I try not to go against the trend anymore unless it's like a quick 9:30 to 10 and there's a lot of volatility and you're trying to buy the dip, then that's different. But if it's overall market conditions and the market wants to go down, don't go long on it or control your position size so you're not getting killed if it keeps going down. So rule number 4 is position size. Cannot stress this enough. Don't trade with money that you can afford to lose, or at least be experienced enough so if you take a bigger position, you are comfortable. Because what I've noticed when I started trading throughout this year is if I trade with larger share size, I have more emotions in my trading and I don't think as clearly as just looking at the charts. So a good example for me is if I were to, let's say I bought AMC at $24 and I bought 100 shares and it went down 2 points. It went down from 24 down to like 22. That wouldn't bother me because I'd only be down $200. But if I bought 1,000 shares of AMC or 2,000 shares of AMC at $24 and went down to 2,000, I would be sweating it because I'd be down $1,000 to $2,000, $3,000. So this is for every individual, especially if you're new trading. I think you should just start small and just work your way up to see what you're comfortable with. Because as you trade more frequently, you'll start to see what you're okay with and what you're okay like trying to swing trade or trying to scalp with. And that's an individual thing, and how much income you have and how much you're willing to dedicate to trading. But you don't want to make impulse trades just because you think something's going to go up. And you don't want to just go all in and you make one bad trade and it just ruins you, because What I've learned from trading is if I have bags and I'm holding like I mean I'm using AMC just because it's here, but let's say you had AMC up here at $30. If you don't have any, if you bought your full position up here and you really wanted to keep trading, let's say AMC, you don't have any ammo now to buy at 22, $23. So I always like to have cash on hand and just watch my position size in case there is a stock or an ETF or something that I want to add to in case it turns red. I think having cash is king because then you're able to make moves when the market presents opportunities. You don't have to take a trade. You wait for the opportunity to come, and you don't have to go in with full size. You can wait for the confirmation that it's actually getting bullish, you know? So like AMC was down to $13, could have been a nice trade to enter a position, maybe something small. And then once you see the confirmation and it's trading above the 200 EMA, then you can go heavier and you can follow the trade as it goes. So that's my advice. Try not to go too heavy and only trade with what you are willing to trade with, and think about when you're trading, are your emotions getting attached, because that will start to let you know if you're having too much of a set share size where you feel uncomfortable, where maybe you're doing 5% of your portfolio is what you're comfortable with, or some people want to do 50% of their portfolio in a trade. It's whatever's comfortable with you, but really think about how is that impacting your trade? Are you looking at support and resistance levels? If the price goes down 10, 20, 30 cents, or you're down 5, 10, 15%, does that bother you? And you need to really assess that for yourself. But I think it's good advice because trading is mostly a psychological game, it seems like, when you're trading by yourself. And most traders that trade will all talk about the emotions behind the trades. And if you can turn into pretty much a robot when you're trading and not have any feelings behind your trades, I believe it makes you a better trader. So I've noticed with myself, when I trade with less share size, I will have more of an objective view versus if I went all in on any stock. AMC's up on the board right now. But if I went on any stock, it would bother me if I was completely down points and I had my entire account in it. So it's just something to think about when you're trading, and like really figure out what's a comfortable position size for you. Because at the end of the day, nobody cares about your money as much as you, and you want to do what's best for you and your portfolio. This fifth rule is don't just trade just to trade. You should be trading when you see setups, or you think, if you're a long player, you think this is a good day to trade because you see that the overall market's strong. I just recommend not taking trades if you're busy, if you're not able to sit at the computer, if you have, let's say you're in school and you have a big test or something with your job, something that's going on that's stressful, that's going to deter you from having full focus in the markets, it's okay to take a day off. You know, if you are not really watching the markets and you're just trading from your cell phone because you think you see like a dip, but you're not really overall looking at the whole picture objectively, you know, I just like to look at the market completely when I'm going to make trades. And I've realized that I've lost money in the beginning of trading I see a dip, I'll be on my cell phone and I can see that DraftKings is selling off, and I'll just buy it because, oh, it was $22. Now it's 19. I should just buy it because it's a good price. You'll always want to be sitting at the computer when you're going to trade, because at the end of the day, it's your money. And you don't want to lose or create a new bag or not be able to stop out because you made a trade from a cell phone, or you really weren't paying attention to the market because you just have other things going on in your life. So that's just an advice. That's something I picked up on, is like, you don't have to trade every day, and the market is going to be here 5 days a week. So you always have an opportunity to day trade. But if you have a busy day, just forget about the market for that day and just trade another day. Live to trade another day. So if you're a new trader, it's kind of hard to have a strategy. But I always say you should stick to the same trading plan for a month at least, just to see if it's working out for you, to see if you're profitable. You know, like, I like to scalp trade, so I'll be in and out of positions really quickly. So I'll try to buy the dip on a low RSI. I'll look for the support levels. I'll look for the resistance levels. Is it bullish that day or is it bearish that day? And then what I'll try to do is I'll try to get in and out and try to make 10, 20 cents at a time. Now, my thing is, I try not to like swing trade. I try not to scalp trade, do options. I don't try to do it all. I just want to be good at one specific way of trading. So if I'm good at scalping and that's my thing, that's what I'm going to try to stick to. And I'm not going to focus on that I could have got a point or two out of it, because that's not the way I trade. But if I was a swing trader and I was trying to get a point or two, I'd be focusing on quality setups on how I can swing trade and paying attention to those stocks and the market conditions that affect them. So I just think it's good to stick to what you actually know. So my last rule to sum up this video is you got to keep your emotions in check. You got to be calm when you're trading. I don't think it's good to be completely emotional and you buy a stock, let's say Amazon, you buy it at 32.70, and let's say it goes down 2-3 points and you start to get all worried and get all nervous. You know, when I'm making trades, I try to have a plan in and I expect what could potentially happen. So if I'm trying to buy the dip, let's say, and I was buying it over here in this zone, you know, and I would have a plan in mind that I'm saying, well, if I buy it here, how many shares am I buying? Where do I plan to sell this? And where do I plan to stop out and take the loss? Or is this a long-term position? Because overall, if you're already getting nervous in the position, I kind of believe that you don't have it planned out. So most traders, when they buy something or short something, they already know where their entry is and where their exit is. Everything's already formulated. You have your plan. And I think that's what helps you build confidence as you're trading. And if you're having a day where you're emotional or like there's a lot going on in your life or something, this is real money, so you don't want to lose it, obviously, unless you're using Thinkorswim and you can practice trade and just use that, which is really great to learn how to use the keys and how to like sell and what's a buy order and what's a sell order. That's all great, but I think you should try to control your emotions and make sure that you're in a good place. And it sounds dumb, but just getting a good night's sleep, exercising, and eating healthy could potentially give you at least an edge, because you'll be thinking more clear and you're not going to be worrying about, you know, do you have something important at your job or something stressful? You know, don't just trade just to trade. Control those emotions, because it'll keep you to live to fight another day when you're trying to day trade in the market, because there's so many odds against you when you're trading against the market, just with everything that's going on, especially if you're trading like Amazon or big stocks and like algorithmic trades and all that fun stuff, that you just want to try to be in the best mindset possible and only trade with the size that makes you most comfortable. So that's all I had. I just figured it'd be cool to make a quick video on like kind of what I do when I trade and what I try to control at all times, and just to have a plan. I have other videos you can refer back to. I think there's like 6 or 7 of them in my playlist that you can refer to. Things that I use to trade. Now, I'm not a professional day trader or anything, but this is just what I've been learning as I've been going. And it's been helping me be more successful and not have like bags and be down like 80% on like a stock, or like buy like, you know, let's a good example is like buy Neo when it was going to the moon last year and it was at like $60. Like, you got to have plans when you buy these things. You don't want to just buy something because it just keeps going up and then you have it at $50 and then you just hold it down to $20. You know, you want to take these things and learn from them and look back at your trades and actually see, did you make a good trade or did you make a bad trade? Did you like draw your support and resistance levels? Did you have an entry and an exit plan? You know, did you get a good night's sleep before you traded? You know, all these little things add up just to make sure that you're putting yourself in the best opportune position to make money. Because at the end of the day, nobody cares about your account. It's up to you to keep it and to keep your assets growing through time. So that's just my quick facts, just what I use to day trade and what rules I try to follow. And I hope it helps out. If you feel like it helped you out, please like and subscribe.